Well, hi there, everyone. Welcome to Chart This with Dave Keller. Happy Wednesday, July 23rd. I'm your host, Dave Keller, coming to you from a just beautiful Redmond, Washington here. It's a sunny day. It is a nice, cool day, but just warm enough. Happy to be here sharing this day with all of you, wherever you're tuning in from. We are streaming live currently on Facebook, LinkedIn, X, and YouTube. I appreciate so much if you're watching live. Always makes it interesting and interactive. As we go along, please drop questions as we go. So any of the charts we're showing, any of the comments we're making, different indicators we're using, tickers you wish we were looking at that I haven't brought up yet, just put them in the comments section on any of those platforms during the live stream. I'll keep my eye peeled as we go, and we'll grab one or two at the end of the live stream. Any of the questions we don't get to, we'll put them in our mailbag. We're planning an all mailbag episode on Friday of this week, and we'd love to answer one of your questions on the air. If you're watching the replay on our YouTube channel, that's great. Put your question in the comment section below the YouTube video, and we'll grab those questions as we go. Decent update for the markets here, right? I mean, just continuing to push to the upside. Paul Montgomery, who was a legendary technical analyst and letter writer for over 50 years. I used to get his weekly commentary back in the day. It used to be faxed around, so that originally was sent out, of course, typewritten, but eventually went to faxing. I think that was one of the few that I still got via mail and then via fax, while everything else was moving to an electronic format. So that tells you where the technology was. However, Paul Montgomery famously said the most bullish thing the market can do is go up. So to be clear, as we go through in recent weeks and talk about dangerous signs that we're seeing, I always start that by saying the trend is positive, undeniably so. Our market trend model is bullish. I would describe my general perspective here as a happy, bullish trend follower, continuing to observe higher highs and higher lows. And I'm going to be continuing to enjoy that uptrend as long as it continues. But I think part of your role as an astute technician, as a astute investor, as a including, you're really focusing on observing the world around you, is to think about the uptrend that we're in and confirm it, but also look for signs that we may be near an exhaustion point. And even if those signs don't ever follow through, there are good early warning signs that have often been helpful to me. Things like the Hindenburg omen, things like divergences in terms of breadth and momentum, leadership rotations. I think this is what makes a bullish phase, really more of a well-rounded perspective, because you're always sort of anticipating where that top may come, and then looking for signs to validate the rotation lower. But undeniably, days like today just show you we are absolutely still in a bull market until further notice. With that in mind, some interesting movements, and I would say particularly in healthcare, there's some charts that I want to share with you today. Through the course of the day, I was identifying some of those interesting kind of breakouts. Biotech's having a decent week here, so I want to share with you some of what's included there. All right, so looking at the major averages here, we can see the S&P up another 0.8%. The Nasdaq Composite, which actually opened up slightly below zero, finished up about 0.6%. The Dow, with the best day of all, closing above 45,000. Mid caps, small caps, all up as well. The VIX now at a 15 handle, almost to a 14 handle, right? Meaning, 15 point something. This is down a full VIX point plus from yesterday's close. We've got volatility low, VIX now below 16. I mean, that is absolutely a low volatility environment. And again, as long as the volatility remains low, as long as we keep making new highs, I think this market is pretty constructive. At some point, that trend is going to change, though, and I'm going to be here when it does, and I'll be sharing with you the signs and indicators that are telling us that that rotation may be happening, but not happening today. This is a pretty bullish day, any way you would slice it. Looking at the fixed income markets, you can see bond prices were lower. The TLT was down about 0.6%. That means rates generally moving higher. You can see the 10-year point finished today around 4.95. That's the long bond, the 30-year yield. The 10-year yield just below 4.4%. The 5-year point just below 4%. Dollar index, really not much of a change. So, nothing really different from where we were on yesterday's episode. Precious metals pulling back a little bit. Chart of gold coming down. The GLD was down about 1.25%. Silver continuing to outperform gold, as we've highlighted on the show, because silver was basically flat for the day. Crude oil prices, not too much of a change from yesterday's close as well. Copper prices moving higher, which is usually a good indicator of economic or demand for economic growth, demand for raw materials and industrial metals, which you use to build buildings and cities and things like that. So encouraging that copper prices are increasing. Gold going down at this point, not concerning me yet. I mean, the chart of gold, the charts of silver, still very strong charts. Gold arguably consolidating more than anything in that ascending triangle pattern, as we mentioned earlier this week. Looking at cryptocurrencies, Bitcoin, Ethereum, and the rest of the top 10 coins tracked on the stock charts platform, all in the red. So this was not a stocks up, crypto up, risk assets all moving higher. This was a stock up, crypto down kind of day, which we haven't had a lot of recently. Bitcoin down about 1.7%, currently trading right around 118,000. Ether prices down almost 5%. You can see others of the top coins here, all rotating lower. All right, looking at the 11 S&P sectors, again, bullish day in terms of sector breadth. Almost all 11 sectors went up, but utilities actually was down today, 0.8% lower. So 10 out of the 11 sectors finished in the green. Healthcare, number one, up 2.8%. We're getting some good earnings. We're getting some good group thematic moves in there. We'll grab a couple charts to share with you here in a short while. Industrials, number two, up 1.8%. Energy, number three. The XLE was up 1.6%. So what you'll notice, though, at the top of the list, no technology, no communication services, no consumer discretionary. Those are the three FANG sectors, or the three Magnificent Seven sectors. They're kind of middle of the road, right? So the S&P was up 0.8%. Technology, communication services, consumer discretionary all underperformed the S&P today. So the juice, right? The stocks that are really thriving here are more in value-oriented sectors. It's not the defensive sectors like REITs and utilities. They're at the bottom of the list. It's not the growth sectors, and they're in the middle. Today was healthcare, industrials, energy, financials. Those are some value-oriented sectors. Healthcare, you can make an argument more of a defensive sector. It really is kind of a weird hybrid of a number of different things. But overall, this is a pretty decent up day with strong price action, strong sector breadth, and strong equity breadth as well. Here we can see the New York Composite Index, where all of these are in the green, really. But the New York Composite Index, about a 2-to-1 ratio. Stocks up versus down, about the same for the S&P 500. Even the small cap index, maybe a little more constructive. But overall, we're seeing a stronger move today, driven by improving breadth conditions. Again, as a stock picker, if that's something you're as you would describe yourself, it's worth noting that even on an update, there were stocks that were down big today, right? Some technology names like Texas Instruments down over 13%, Microchip down over 6%, Enphase Energy in the renewable energy segment down 14%. That's your worst performer within the S&P 500. So not everything was up, but more things were up than were down, basically. All right, looking at the Magnificent Seven stocks, we can see NVIDIA up 2.25%. That's the best performer. Broadcom, number two, up 1.8%. Meta up 1.25%. I'm actually working on an article for the Stock Charts blogs here. Hopefully we'll get that done. I was trying to get it done before the show. That's why I was a couple minutes late. And I don't know about you, if you ever write professionally or if you have a deadline. There was this moment about 25 minutes ago where I kind of looked and I'm like, I could try to get this article done, or I could just take some deep breaths and prep for the show. I went for option A. I'm going to try to get the article done. Of course, I did not get the article done, and then I didn't get the show launched in time. It was a masterclass in how not to schedule your afternoon, but hey, I'm not perfect, right? It happens some days. Having said that, I am working on an article on Meta. I think there's a couple ways you could think about the recent price action, which I'll lay out in that article. So keep your eyes peeled on the Stock Charts platform later today. NVIDIA and Broadcom are both up, and that's encouraging, particularly NVIDIA, because the semiconductor stocks have been struggling this week. And certainly in July, we've seen more and more kind of red flags popping up there. So good to see stocks like NVIDIA, after bouncing higher, after 3 straight days of closing lower here. Netflix down another 1%. The chart of Netflix is just, it's just not great. We have Alphabet down slightly, not too bad, but I mean, the chart of Netflix is it's just not good, right? So we broke below the 21-day EMA. I don't have that on this chart, but it's kind of up here. We broke below the 50-day moving average. That happened, last Friday. And then so far this week, we bounced up to the 50-day. Nope, it rejects it. And now we're continuing to rotate lower. The RSI now drifting below 40. So, I mean, in my opinion, Netflix at best is like a neutral chart, right? It's like it's a yellow light. It's not a green light anymore. When we start breaking the 50-day, for me, that's more of a yellow light kind of move. Between the green and the red, meaning between the 50-day and the 200-day, I think of it as more of a yellow light, and below the 200-day moving average, more of a red light. So, again, Netflix is not the market. It's one stock, but again, more of these kind of charts start popping up, I'll start to get more concerned. There are a lot of stocks just working though, and that's what we're seeing when we look at the major averages. All right, I think that's it for the front page, kind of summarizing things. Long story short, market's going up, and again, nothing I'm saying changes that reality. That is why I have a market trend model that is front and center on my dashboard. It is literally the first chart I look at every day. I'm not making that up. I fire up the laptop. I look at the weekly S&P chart with my market trend model. It's just to reinforce, here's what the market has done up until this moment as you start evaluating a bunch of different charts through the course of the day. So as long as this market model remains bullish on all timeframes, which it is, I'm going to remain bullish on this trend, right? And assume that this trend persists. There's a lot of reasons why the market could continue higher. There are plenty of reasons I could cite for you why the market should not be going up. Market doesn't care. So what we do in this scenario is confirm the uptrend and participate as long as we can, but always be looking for signs of a downside reversal. Look for early warning signs, which are some that we've highlighted recently, but look for breakdowns, which is what I think we're seeing on like the chart of Netflix, for example. All right, let's continue on as we go here, moving on to the market carpet. We'll talk about some of the themes that we're seeing around this kind of modeled heat map, to be honest with you. There's some good, there's some bad, there's some in between today. We'll try to highlight a little of all three. I do see some really good questions coming in so far. Please keep them coming. Any questions that pop in your mind, if you're tuning in live, please pop them in there. I'll grab one or two before the end of the episode. Any of the questions we don't get to, we'll put into the mailbag, and we'll do an all mailbag episode on Friday. I do want to give a special shout out and very much thanks to Larry on YouTube with a very nice super chat and a tip today during the live stream. He said, "Thanks for sharing your knowledge nuggets with all of us." I'm so glad you find them helpful. I hope you can pick up on the fact that I enjoy greatly doing the show. I have a blast doing it. I miss it when I'm not here in the office able to do this. It brings me great joy. I love seeing the questions. I love if there are things that we talk about that help you make better decisions. And I appreciate that very kind gesture, reinforcing some of those things. So Larry, thanks so much for watching as always. Thanks for being an active participant, and thanks for the thanks today. All right, let's look at the market carpet here. So, I mean, as with many days this week, I'm immediately drawn to the green right in the middle of the screen, right? The fact that healthcare continues to be a strong, sector. Someone mentioned earlier in the chat, I can't find it. Chuck, I want to say on YouTube, saying I've been waiting forever for healthcare to rotate. Right? I mean, healthcare has been a chronic underperformer, just a chronic nothing burger in terms of its inability to register any meaningful performance. You'll have these little kind of counter trend moves, but like that's it. Biotech has not been particularly great. Pharma at times has kind of popped, but nothing sustainable. And the XLV has just been one of those underwhelming charts. But it's really starting to change here in the last couple of weeks, really, from the last couple of months. Look at today, right? I actually grabbed the chart of Boston Scientific to share with you, making a new 52-week high today. Eli Lilly and others, right, have been beaten down for quite some time, and that these are the, so like Johnson & Johnson breaking out, Boston Scientific breaking out, Gilead not quite there, but like trying to break out. But then you have these other ones that have just been in these chronic downtrends, right? Like Molina Healthcare, MOH, DaVita, DVA. This is one that's bouncing off of lows. Thermo Fisher Scientific, up 10% today. So these are charts that have looked, I mean, aggressively bad. I mean, puke out bad really through the end of June. And then all of a sudden it starts to reverse. I didn't grab this chart, but now I want to look at it together with you. Is this the best chart I've ever seen? No. Is this the most encouraging chart? Would I take a long position today? I probably wouldn't, because we've sort of gapped higher. I mean, that's a nice rotation higher, and I love the break. We're kind of closing at the lows. We're still below a downtrending 200-day moving average, but this is a pretty impressive rotation, right? From a distribution phase of lower lows and lower highs to a consolidation phase of static highs and lows to exclamation point breakout today. So charts like this have been struggling on a relative basis, on an absolute basis. It's really starting to change, and this is an earnings name today, popping higher on earnings. And I think that maybe we'll see what happens through the entirety of earnings season. But I think one of the sort of great takeaways so far from July 2025 has been potentially like the rebirth of the healthcare sectors, right? And some of these names finally breaking out in a way that that we've been waiting for. Some of these which have been underperforming starting to improve. This still very much feels like a stock picking exercise, though, because like Waters Corp, still not a great chart. I would not be big on taking a position on something like that, because I think it's still pretty underwhelming. United Healthcare, I see the question on that. It's like, okay, right? I mean, it's gone from bad to not as bad, but it's not gone from bad to good, right? Look at this. I mean, just really look at the specifics here. We're putting in potentially like a higher low. It's almost like a retest of that May low here around 280, and we're rotating higher a little bit. But like for me, it's like getting above these moving averages is what starts to really change the configuration of this chart. So I like the fact that we're pulling back and making a higher low compared to the May low. That was this big hammer candle right at the bottom, by the way, if you want a good example of that. Maybe a higher low here. Are you super aggressive? Maybe you take a position here with a stop right at 280. Like that is all I would personally put at risk for this kind of chart that I still think has a lot to prove. But I think if you can get above these moving averages, if you can get above like 320 and clear this, kind of make a new 3-month high, this above 320 for me, that's the alert I'm setting. I'm jotting it down right now. That would be alert. That would be a move that would tell me, okay, we are now completing this rotation from consolidation to accumulation. I think that's how I would think of something like UNH. What else here on the heat map to think about? I mean, defensive sector is not doing great today. You can see some random consumer staples named like Lamb Weston's up 16% today. So earnings season has a lot of stocks gapping up and gapping down on any given day. But I would say generally consumer staples clearly lagging, with not a lot of stocks going higher today. Same with REITs. Same really with utilities. I mean, utilities clearly looks like the least attractive mover today. NextEra Energy just made a new 3-month high yesterday and is down 6% today, kind of back below that breakout level. I think that chart breaking above 75 was pretty bullish. Now that we're back below 75, I think that's a wait and see kind of chart. I think that chart above 75 completing that rotation is pretty good. So a bit of a whipsaw today after yesterday's breakout. But again, so defensive sector is not looking great. I think that's it. I mean, and then finally with technology, right? Think back like 2 months or so, right? Think like kind of May, June, when we're really accelerating off the April low. There were days when it felt like all of technology was green, right? And there were days where it was like technology and then everything else. That's not the vibe I'm getting this week at all, right? I mean, if you look at technology, it looks a lot like the other sectors where there's just kind of a very diverse list of returns here today, right? From NVIDIA up over 2%, Palantir up over 3%, AMD up 2.5%, but then you have Texas Instruments, Enphase, ADI, Analog Devices, pulling back after making a new high. CrowdStrike back below, pushing below 460 now, going into the close, down another 2%. So it's a little more diverse, right? It's less of an obvious sector call and more of like a stock picking call and just looking for opportunities within the sector. That's what it feels like more to me looking around here. So the question is going to be what kind of takes control and what's the new leadership kind of emerging, right? And I think that's arguably the most important question right about now. But I'm very much getting a rotational feel here. The dominance of technology seems a bit like a question. Sectors that have been struggling, like healthcare, starting to look more encouraging and interesting. And then there's industrials, which has just continued to be one of the strongest plays. A lot of defense names trending higher, like General Dynamics, RTX, all up pretty good today. Fascinating time to be analyzing the markets, and I'm thankful for the opportunity to do it with all of you. Let's continue on looking at some charts together. We'll take a couple questions. We'll call it a day here. Hump Day, July 23rd. So the chart of the S&P, right? I have these lines on here highlighting a potential divergence. And with what's happening this week, it's starting to look less and less like that divergence is reasonable. I will tell you what I mean, right? When you see divergences, that's an early warning, right? That's an early warning sign that we may be near an exhaustion point. I think just on the same chart, you can see an example of where the divergence tells you, okay, we may be nearing a major top, right? Look at the new high in February and look at the RSI up here around 70 in December, here around 60 as we're making new highs. So that's a new high on weaker momentum. That's a bearish divergence, tells us we might be near an exhaustion point. Now, for me, those early warning signs are not enough to really change positioning too much because the trend is still up, right? Things are still going up. So what you look for is the breakdown, right? You look for a validation that, yep, that divergence really has taken hold. And now we're seeing distribution and breakdowns below moving averages, breakdowns below Fibonacci support, RSI breaking below 40. These are all things in like late February into early March that tell you, okay, this is definitely feels like the beginning of something much more significant. So here we're kind of like where we were in mid-February of 2025. Mid-February, a little weaker momentum, but like we're still making new highs. And so I think that's all we've gotten here, sort of the early warning signs that things may be rotating lower. Today, though, we're making a new all-time high. The momentum is back to being quite strong. So you can see this line I drew tracking these lower peaks, all of a sudden no longer that reasonable anymore. So I'll probably delete that divergence and say, nope, it's similar to what we saw in May and June, potential, divergence, but we never really broke down. That's why in this environment, it's like the early warning system is the divergence. The more important sign is when we actually break down, and pulling back to like the 21-day EMA is not a breakdown. That's just a really healthy pullback within an uptrend. Arguably, one of the more significant things we could see if you're bullish right about now is a decent pullback, right? To sort of, reset things and make it not feel like this market is so ridiculously overextended and overvalued. Decent pullback can make everything seem a lot more palatable and can make future highs seem a lot more reasonable and understandable. So that's a concern. I mean, big picture, and this is something we'll talk about with my premium members, certainly in the monthly chart review coming up in a week or so, is the seasonality, right? I mean, the challenge right now is we're going into a seasonally weaker part of the year. August and September, not great months in a post-election year, not great months since COVID, not great months for the last 20 years or 50 years. That's kind of where the seasonality would tell us. The market can just go higher all the way through the end of December. It's much more likely the seasonal pattern would suggest we probably get some weakness in the August-September timeframe. But for now, it's not happening today. And it's not just on the chart of the S&P. Here's a chart that I call the newer Dow theory, looking at the equal-weighted S&P 500, the equal-weighted NASDAQ 100. When both of these are making new highs, that's not bearish. When one is making a new high and the other is not, that's where it's a little more concerning. It's something we highlighted in mid-June. Now, as we mentioned before, the chart of the S&P never really broke down after that. So it was sort of an all clear, and we're making new highs. Now, just this week, we're seeing both of these equal weighted indexes making new all-time highs. So that, by definition, is called a bullish confirmed reading on the Dow theory. And again, I'm using what I call the newer Dow theory. It's adapting Charles Dow's work, kind of modernizing it. I think using the equal weighted S&P and the equal weighted NASDAQ is a pretty good way to make that assessment. By my read, that's a pretty bullish follow through. The breadth's starting to improve, right? The McClellan oscillator was below zero. I would guess, based on the move we had today, that we could see the McClellan oscillator go back bullish. But for now, as of yesterday's close, it wasn't. But some of the breadth indicators we've been tracking, actually starting to improve again. We're now up to 67% of the S&P members above their 200-day moving average. It was down around 50% about a month ago. So from mid-June to mid-July, almost 20% of the S&P have broken back above their 200-day moving average. That's pretty encouraging. We're back to over 75% of S&P members above their 50-day moving average. So breadth conditions starting to improve a bit. Where we're not seeing great breadth at this particular moment is with the NASDAQ 100 bullish percent index. Going back to what we talked about on the heat map, right? Talking about technology maybe not being in as much of a leadership role anymore. This chart really tells you the bullish percent index on the S&P is kind of breaking back higher. The bullish percent index on the NASDAQ is continuing to trend lower, even as the S&P and the NASDAQ themselves are making new highs. So what gives with that? Well, this is looking at the NASDAQ 100 charts, and it's recognizing that charts like Meta are starting to break down, and they're registering sell signals on their point and figure charts. So on a day like today, it wasn't technology driving the market higher. It was industrials and financials and materials and healthcare. So the NASDAQ breadth is actually trending lower, even though the major averagers are going higher. So at the very least, this tells us we're having a leadership rotation, particularly if the market keeps going higher and this keeps going lower. That is as big of a signal as I think you can find, that if you've just been riding the glory of technology all through 2025, I don't blame you, because it's been by far the best sector. This is starting to tell us maybe it's not the place to be going forward. It was the place to be looking backwards, but we get paid about what happens after today, not what happens going into today, if that makes sense. Tariff news just continues to be top of mind. We did have the deal announced with Japan, the Japanese ETF ticker EWJ, making new all-time highs today on that news. So the EWJ up almost 5%. That gap higher gets us back above the 50-day moving average, gets us back above the swing high from late June, and gets us back in a positive trend, I would argue. The momentum is strong now with the RSI spiking above 60, nearing 70 on that rally. The chart of Japan has been more, questionable. It's been underperforming the S&P here, but now we're really starting to see an improvement with that gap higher, really reinforcing the bullish phase that we've seen off of the April low. I set an alert. I don't know when I even set that, earlier this week, end of last week, for when biotechs broke above their 200-day moving average. And particularly, I was looking for when it would break above 134, because that would get us above the 200-day and get us above the swing high from early July. That was triggered today, right? Soon after the open, I got the alert on my phone, got the alert on stock charts that the biotechnology ETF had broken out. So if you've been avoiding things like biotech because they've been underperforming, again, I don't blame you. If you've been avoiding biotech because it's been below a downward sloping 200-day moving average, I don't blame you either. If you're avoiding biotech now that we're above the 200-day moving average, that we're making higher highs and higher lows, that we're above an upward sloping 21-day moving average with the RSI consistently be above 50, I may start to blame you here, right? Nothing good happens below the 200-day. That's Paul Tudor Jones' famous quote. But the other side of that is when things get back above the 200-day moving average, that actually is a pretty encouraging sign. So, if you've been avoiding healthcare, again, I don't blame you for recognizing clear weakness and underperformance, but I think there's been enough of a move that you've been completely ignoring it. I don't think you can ignore it anymore. At least I certainly am not ignoring it. Now, it's not just biotech. This is Boston Scientific, which is in the medical equipment group, making a new all-time high today. If you look at the chart of BSX, there's the high from February, the high from May, the high from late June. That was broken today. We actually closed right at 107 and changed right at that previous swing high. I would love to see further upside follow through, but for now, it certainly looks like a breakout is happening. And if we get at valid breakout, good follow through going into this weekend, I think that indicates much further upside for Boston Scientific, which really has been relatively flat from February to July. We're right around at the same level. Can we get an influx of demand or an influx of buying power, as we would say, propelling the stock to new highs? The setup today suggests that may be the case. That's up 4.5% today on earnings. End-phase energy. If you're talking, think about what charts look great. So if those charts look great, are there charts that don't look great? There definitely are. And you saw in that market carpet, there are a bunch of little boxes that were red. End-phase was one of those. This was the worst performer, I think, in the S&P, down about 14% today. Certainly in the top 5 worst performers. This is a stock that has consistently been below a downward sloping 50-day moving average, which is consistently below a downward sloping 200-day moving average. The last time that the RSI for end phase was above 60, I can't tell you, because going back for the last 8 or 9 months, we've never gotten even close to that level. We've barely gotten above 50. So for me, this is a friendly reminder, and I love examples like this that just reinforce, while it can be super tempting to buy things that are in downtrends, while it can be super tempting to buy new 52-week lows because you think, how far can it go? We used to have a joke in my Fidelity days: never confuse the bottom of the page with support. And we always joked about that because the chart room used to be all done by hand. And if the stock would go down or the index would go down enough, you'd have to literally add a new piece of paper below the other one so you could continue drawing the chart downward. So just because the price has gotten to the bottom of the monitor or the bottom of the page doesn't mean it can go lower, right? It doesn't matter. And so things that are in downtrends are going down for a reason. I get excited about a chart like this when we see upside follow through, when we start breaking above trend lines, when we start getting back above the 50-day moving average, when we start experiencing higher lows. Those are all things that are more exciting to me. This is a chart that I would not touch until you see enough signs of accumulation. We'll finish on a positive note. I would not call this like a cup and handle pattern, although it looks kind of like one, but it's kind of a weird misshapen cup and a handle that's way too big. So I don't know if I could do that, but I will tell you that Toast is making a new 52-week high in the month of July. It has what we call the moving averages in proper order: price above the 21-day EMA, 21-day above the 50-day, 50-day above the 200-day. They're all sloping higher. RSI consistently above 50, not overbought right now. Charts like this seem like great breakouts. These are why when I see setups like this, I look and I see the level and I say, all right, tell me when this breaks above 46. When that happens, that's going to convince me that there's accumulation. There's new buyers coming in willing to pay more for the stock. That's what we've observed here in the last week. That's why I think Toast has a pretty decent setup with potentially some further upside potential. Let's take a question or two and we will call it a day. JB, thanks for watching on YouTube, my friend. You asked, Dave, why don't you use the exponential moving average for the 50 and 200-day moving averages? Why use the simple moving average for the 50 and 200-day and the exponential for the 20-day? It's an awesome question, and I appreciate you, watching what I'm doing, thinking about, and coming with a very thoughtful question like that. Much appreciated. So I actually use the 21-day EMA. Why the 21-day and not the 20-day? That's an awesome question. That's a great question. Honestly, with short-term moving averages, people kind of go back and forth between like 20 and 21 because that's the trading days in a month. So that it's one of those. 21 is a Fibonacci number. That's probably why I naturally kind of go to that. I just find this beautiful poetry and symmetry in the markets when Fibonacci numbers make sense. Having said that, the chart of Royal Caribbean is an illustration of this moving average configuration that you mentioned. And as a reminder, I have 3 moving averages on my sort of default chart. The 21-day exponential moving average for me is like the short-term tactical level to watch. Then we have the 50-day and the 200-day moving average, simple moving average. And the 200-day is an important one as well. So why those 3? So for the longest time, I used just 2 moving averages, the 50-day and the 200-day simple moving average. And I use that because I worked with so many investors, and most of my career has been spent, much of it with institutional investors, money managers, brokers, strategists, and helping them use technical analysis and make better decisions. And one thing I found from working with hundreds, if not probably thousands of money managers over the years, investors that were running huge funds that were not big chart people, they were more fundamentally oriented or quantitatively oriented. They always seemed to know where the 200-day moving average was. It was just like you had to know it because that was a common language we would use to talk to people at different shops, thinking about things at their 200-day moving average. Any trading desk I've ever been on, buy-side trading desk, where you're actually executing for the big funds, they would always know where the 200-day moving average was because they knew from experience in the pits or just in the practice of trading that stocks would often bounce off of their 200-day moving average. They just needed to know, because that was an important level. So the 50 and 200-day simple moving averages were always way more easy to calculate, right? If you're doing things by hand, it's hard to calculate an exponential moving average. Pretty easy to add up 50 closes and divide it by 50. Takes a little bit of time, but you could do it. And so simple moving averages are kind of the conventional practice. Most charting platforms default to the 50 and 200 days. So even people that aren't big chart people tend to look at those levels. And that's why I find it's very, very helpful. Now, if you ask me what moving averages have the best way of tracking the trend and recognizing changes in trends, exponential moving averages are way better because they're more sensitive. The problem with a 50-day moving average is what happened today and what happened 49 days ago has equal importance, right? Because you're just adding up all the closes and dividing it by the total. But an exponential moving average weights the more recent data more heavily. So it's more sensitive. So when something moves, the exponential average is going to turn more quickly. So the 21-day exponential moving average I found has added a lot to my own trading because I would find this sort of situation where Royal Caribbean never gets down to its 50-day. And I'm just sitting kind of looking at the prices and wondering why my moving averages are not being particularly valuable at the time. I added this 21-day EMA, and I find more often than not, it is a really good kind of swing trading tool. It helps you identify tradable pullbacks within an uptrend. When it's finally broken, it tells you the tactical trend is starting to shift. And so those three have become the ones that I use. That was a long-winded answer, but I hope that answers your question in terms of why I use those three. I mean, are those the only ones you can ever do? Absolutely not. And I've worked with people that swear by some other moving average combination. For me, the moving averages that you use on your charts should be helpful for the questions you're trying to answer. And those three, for whatever reason, hopefully some of the reasons that I explained to you, those are the three that have resonated the most for me. And I hope that it's a good starting point for you as well. Folks, that'll do it for today. Thank you so much for tuning in on the show. Thanks for some thoughtful questions. I don't have all of the time to get to all of them, but I will put some of those questions into our mailbag. We're planning an all mailbag episode on Friday. You might see this little pop-up here. Actually, sorry, I'm not showing the screen anymore. You might see this pop-up. Can I do it so you can actually see it? Yeah, the experts break down crucial market action from a historic first half of 2025. Grayson Rose and I recorded a Stock Charts TV special yesterday. Apparently, that is now ready to go on the YouTube channel. It popped up as we were doing the show. So check that out. Also, the latest episode of the Market Misbehavior podcast should be out here within the hour. I sat down with Adam Koch. Adam is a wealth manager and advisor coach based in Columbus, Ohio. He is an Ohio State grad, so you will get some Buckeye talk a little bit at the beginning and the end, but the meat of our discussion really focused on how financial advisors like Adam are able to use technical analysis, not only to analyze the markets and think about positioning and allocation, but also to enrich their discussions with their clients. So if you're an advisor or if you work with one, I think you'll find it a really good episode to maybe think about that relationship between charts and psychology and managing your own or other people's money. So check that out on the Market Misbehavior podcast. I'll say good night. Thank you so much for tuning in. I'm Dave Keller with Market Misbehavior, here to remind you it is always a good time to own good charts. Have a good night, folks.